Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks slip following strong U.S. jobs data, while oil climbed to the highest level in more than 4 months as a fresh wave of U.S. sanctions against Russia threatens to hit supplies. China's central bank is taking up new measures to beat investors betting on a pessimistic economic outlook. The PBOC ramping up support for the yuan and government bonds, but will it be enough to shake off the gloom? And we speak exclusively with Hong Kong's Financial Services Secretary Christopher Hui about how the city's fortunes could be affected by China's economic woes and increased geopolitical tensions. Welcome to the show. The blowout U.S. jobs report has left risk assets vulnerable to further declines. Higher yields are threatening Wall Street's rally, and Asian stocks are extending the slide. Avril Hong is here with more. And Avril, of course, more gloomy outlook expected.
Yeah, there's a lot of pressure already on Asia stocks, and they could continue extending these declines. You look at the region's benchmark, excluding Japan, it is at its lowest level since August, after that U.S. jobs report painted a really bright picture for the labor market. You saw how payrolls jumped by the most since March, the jobless rate ticked lower. You saw how the July print, importantly on the jobless rate, was revised downwards, and this was what helped unlock the September 50 basis point rate reduction. So traders really pushing back their rate cut bets. If you look at swaps, it's something like October, and Bank of America doesn't even see a cut this year. So amid all this, what you're seeing is the prospect of 5% yield. I mean, you think about how on Friday it was already 4.75 on the US 10-year. That's really sapping appetite for not just US but Asia stocks. And you see also how these stocks are really coming under pressure. Has.
Avril, it is about the Chinese economy, and we have the latest trade data out of China, and it does seem like it is better than expected. Let me take a look at the numbers right now. China's December exports in USD terms rising 10.7% year on year. The estimate was for 7.5%, so quite a beat there. In terms of December imports in USD terms rising 1% year on year. The estimate was for a contraction of 1%. So on balance, it is better than expected. And in terms of exports in particular, the numbers continue to rise. China exporting a lot more than before, despite all the measures put in place to limit China's exports out there. Now, speaking of China, as gloom grips the outlook for Chinese markets, the country's economy is the focus at the Asian Financial Forum in Hong Kong and the UBS Greater China Conference in Shanghai. PBOC Governor Pan Gongsheng told the AFF that the central bank will make use of several tools to maintain ample liquidity in the market. The China Show co-anchor David Inglis joins us live from the AFF. Our China North Asia correspondent Stephen Angle is also with us from the UBS Greater China Conference. Dave, let's start with you. We're seeing action in the market already. I mean, ebbing between gains and losses, trying to reverse the losses already. So investors obviously trying to make sense of what's out there. But in terms of what Governor Pan did say, there was nothing new in those comments.
Well, it's a reiteration of, number one, the commitment really from policymakers that they will do what it takes to reinflate this economy. And I think it's a tricky period for policymakers because, we're in between and we're still waiting for, the economy to respond in a big way to all of the pronouncements so far. High frequency data does suggest that there are parts, say, of the property market in first-tier cities that have started to respond. But again, talking to markets that are impatient, that want either an earnings story to turn, or an economy start to turn, we're in between sort of phase one and phase two, which is really March when the NPC begins. That policymakers have to come in almost on a regular cadence to talk to markets And I think a very good example of that, to your point, was the PBOC governor did make that surprise appearance today here in Hong Kong, addressing an international market, addressing perhaps alluding to your other point earlier on, sentiment that does remain wanting. He talked about three basic things. I won't go into too much detail here, but he talked about liquidity measures, and a lot of that has to do with the fact that how do you maintain liquidity while also backstopping a currency that is really on the losing end of a stronger dollar, number one. Number two, the role of Hong Kong in China's sort of greater efforts to reform its financial market. Again, number three as well, the headwinds, and this is important, the acknowledgement that a lot more has to be done, particularly when it comes to bolstering consumer confidence. In fact, on that very point, let's listen to what he had to say.
We'll also implement an appropriately accommodative monetary policy, adopt a mix of monetary policy instruments, including interest rates and required reserve ratio to keep adequate liquidity and favorable social financing environment.
Yeah, there we go. So things are still ongoing. We're still in the first couple of hours, of course, at the AFF. So we have a good conversation coming up here with Christopher Hui, talking about how Hong Kong's efforts really to shelter its economy and some of the specific steps and measures that they have in place for the investor community. So suffice to say, we're in the thick of things here. Back to you.
Well, Dave, just to follow up on the conversations you've been having there, obviously Governor Pan said the right things, and he talked about how there are tools out there to counter the slowdown in the economy and to support the markets as well. What are you hearing on the ground at the AFF? Are investors, companies buying into what he's selling?
Well, a lot of it has to do with how much patience. It's a type of investor you are, I think, is the short answer to that. For tactical traders, one part of the conversation going into this week was, is this a market that, again, will likely see a technical bounce, and how long that bounce lasts going into the Lunar New Year in a couple of weeks. For longer-term investors, it's really to hear the story about what China has in store to make sure we don't find ourselves in the situation that we found ourselves in with some of the structural issues like debt, the property market, that we don't find ourselves in that situation again. I think that's one part of, to answer one part of the question. The other one is separately, the AFF does attract some fairly big, some big names. In fact, just on that very note, our first guest this morning here was out of Pakistan, of course, out of the finance ministry, and the finance minister to be more specific. They're talking about this IMF program, this loan, of course, that is reviewed on a semi-annual basis. So a couple of things there. One is he's confident that they can secure the next tranche. He did give us timing, by the way, on when that next mission from the IMF will be coming, which is end Feb. That's number two. And number three, that they are looking to tap the global bond markets this year. A lot of ifs there, but if indeed we do see credit upgrades to the sovereign rating, they might actually also consider raising money in the yuan debt markets, the panda bond, of course, which they've flagged earlier on. So yeah, multifaceted conversations here.
Great conversations there. Let's get the conversation going as well with Stephen Angle, who's at the UBS Greater China Conference. Steve, of course, we're having this conversation on the back of exports, China exports rising to a record. And of course, we're counting down to Trump getting in office. He's going to not look too kindly to the numbers that we're seeing today.
Yes, but you could also argue that some of these export numbers are front-loading of orders coming from the United States ahead of any tariff action that could come and disrupt and increase prices of Chinese imports to the United States. So it's a good thing as far as the Chinese policymakers. I was sitting here in Shanghai ahead of an interview with Tommy Fang. Tommy Fang, who's the UBS head of China Global Markets. We were both listening to him quite closely to see some of the stimulative measures and what kind of levers the PBOC could pull to kind of stabilize what has been a very moribund and sluggish economy. And I guess he heard some right things. Also, earlier this morning, I did speak to, essentially the guy who's coming over to be the co-head of global wealth management, a division head for the first time of UBS is going to be based in Asia, Iqbal Khan. He is also the head of Asia banking as well. He told me in an exclusive interview that the people here, the 3,000 participants at the GCC, the Greater China Conference, are trying obviously to navigate the incoming Trump administration, also a potential longer Fed pause. But more importantly, perhaps, is when are we going to get the kind of stimulus that the Chinese economy needs to put a floor on this slowing economy, but also give it rocket boosters to go back up again. Here's what he had to say.
We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
Now, Iqbal mentioned March. What happens in March? Well, every year it's the annual session of Parliament, the National People's Congress. That's when perhaps the market participants here are betting that there could be some pro-market and pro-consumption stimulus to get this economy going again. We have to wait a couple more months, but in the meantime, his advice to market participants is diversify, diversify, diversify. Haslinda?
But even as you diversify, Steve, I mean, market participants looking for big bang stimulus, we're talking about QE, for instance. Any sense at all with the people that you're talking to where you are at the UBS conference, whether or not it is coming?
Yeah, well, we heard, there's expectations that there are definitely more levers to be pulled by authorities, whether that's with the interest rate cuts here. Also, of course, the reserve ratio requirement at banks. There is room there to lower those and get more funds that have to be held at the big banks out into the economy working. But right now, there's a crisis of confidence, obviously, with the consumption trends not trending well. And the stock market is definitely reflecting that. The stock markets here onshore in China have hit a bear market territory with the Morgan Stanley China index down some 20%. The main CSI 300 index also down about 12% since those October highs following that first boost of sentiment when we got that mini stimulus package at the end of September. That has pretty much petered out. So the market participants waiting to March, see if they get some teeth behind the talk that Gongsheng and other policymakers have been delivering.
Proof in the pudding. Our Chief North Asia correspondent Stephen Angle in Shanghai and the China Show co-anchor David Inglis in Hong Kong. Thank you so much for that perspective. Still to come, we'll have more from Steve's exclusive interview with UBS Group's global co-head of wealth management, Iqbal Khan, and his views on China as well as the Fed. Plus, we speak live and exclusively with Hong Kong's Financial Services Secretary Christopher Hui for his insights on the city's economic outlook. Well, let's get insight on the market moves with Stephanie Leung, CIO and Digital Wealth Manager, StashAway. Stephanie, good to have you with us. We heard from Steve and David about how, Governor Pan is trying to allay concerns. But of course, the stock market started on a very difficult way. It's worst start to the year in about 10 years. Have you been, I guess, swayed into buying into the China story by Governor Pan?
Yeah, I think, we've commented on China quite a number of times in the past few months. And what we've said is that, there are kind of external, internal factors that are affecting kind of how the Chinese assets prices are reacting. So, for example, there are some things that the Chinese government can control, but there are a lot of things that the Chinese government really cannot control. One of which is, of course, the strength of the U.S. economy. And I think if you look at U.S. 10-year Treasury rates or even the U.S. dollar, they've been very, very strong on the back of still surprisingly strong U.S. labor market. And this is one factor that is not just affecting China, but also the broader kind of emerging markets, currencies and assets, including, for example, one of the favorites for foreign investors, India, right? So this is not something that the Chinese government can really really control. And I think this is why the PBOC and the Chinese authorities need to sort of like communicate from time to time the intent to sort of stabilize the renminbi, particularly at these sort of important levels where it's kind of reaching historical low, and if they don't come out to communicate, risk kind of spiraling even further downwards. The other aspect they can control is, of course, the potential for tariffs when Trump administration actually comes on board. And this is one bigger risk that a lot of investors and also Chinese government is concerned about. Now, there are a lot of things that they can control. However, if we look at kind of the timeline of things, I think we've all talked about the March MPC being really the big meeting and the big opportunity where they come up with much more pro kind of market policies. But from now till then, it's still kind of 2-3 months away. And we have the Chinese New Year coming in like pretty early as well. So there's sort of like this vacuum period where I think investors are kind of looking at a lack of further big announcement from China. So I think during this period, what makes sense for the Chinese authority to do is to just be able to stabilize things and not let things kind of spiral out of control.
So on balance, how does it look? Because the likes of Goldman are betting that Chinese stocks could rise 20% from here. What are your own expectations?
Yeah, obviously Chinese stocks have had a pretty decent run last year. So if it didn't feel like a bull market, but indeed, if you look at Chinese assets versus other markets, Chinese assets actually ranks quite on top, just slightly below U.S. stocks. So it didn't feel like a bull market, but indeed, it was a pretty good run. So I think there's a potential for the continuation of this bull market. However, this is predicated upon, I think, further policy announcements. And I think what we've been saying, and also a lot of economists have been looking to, is more pro-consumer, pro-consumption policies coming out from China. Because I think we're pretty used to, or I guess the traditional way of doing monetary stimulus and also supply-side stimulus that has been announced. However, the market and what we really like to see is sort of more direct stimulus to encourage the consumer and also investments from the business side. Because we think that if we look at like the money supply and also liquidity data from China, it's not the key issue, right? The key issue is that property prices continue to fall, and also business investments and also consumption numbers are not picking up despite a lot of these sort of more monetary stimulus. So I think what we're looking for in 2025 for Chinese equities or for Chinese stocks to further rebound is predicated upon some more direct kind of signs or policy kind of changes in terms of making the consumer and making the investment business investments coming back a lot more in the new year.
Stephanie, the yuan also in focus with how the PBOC providing stability, fixing it at 1,000 pips stronger than anticipated in terms of analyst expectations. I'm just wondering, at some point, the PBOC will have to let the yuan ease further to reflect, the economic conditions in the country. How are you looking at how the yuan may play out in 2025?
Yeah, I think it makes sense for the yuan to kind of weaken to support the economy. However, the key really is the pace of the weakening. I don't think it's either the PBOC or even BOJ or other central bankers would love to see kind of currency move in a very dramatic fashion, because any time you introduce volatility in the system, it actually would potentially tip other scales, for example, like banking stability or kind of trade stability, etc. And I think also you need to think about on the other side, right? If the Chinese yuan weakens significantly, how is it going to play on in terms of how Trump thinks about trade, how Trump thinks about their currency? So I think there is sort of will and kind of, I hope that from both sides, both in the U.S. and China, that there will be a stable kind of depreciation of the currency and not any kind of dramatic moves. So, I mean, this is something that I think it'll play out throughout the year. Of course, a lot of that has played out in the last few months already, given that the US dollar has been strong, given that US economy has been much stronger than the rest of the world. We'll see if that changes, right? If I think China comes out with much more forceful stimulus, then the yuan can actually stabilize further from here.
Stephanie, thank you so much for your insights today. Stephanie Leung, CIO at StashAway. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. The global co-head of UBS Wealth Management says Beijing's more proactive fiscal stance will be as relevant this year to markets as what happens in the US. Iqbal Khan also told us exclusively how he sees a slower pace of Fed rate cuts affecting investment decisions.
Well, generally, the entire rate curve and everything around rates policy, as well as inflation, has been a key topic and has now reignited again with what we're seeing in terms of the rate curve and what you just mentioned. There was a Bloomberg headline just this morning around scratching 5% in terms of 10-year yields. Having said that, we do still expect a gradual reduction in rates, but we will have to work through in scenarios. Why do I say that? We're waiting for an inauguration. We will see what the U.S. administration will be doing. There are scenarios out there. We need to work through those scenarios. We do believe that there will be continued rate cuts, maybe albeit a bit slower than anticipated, but this is something that we will have to work through.
You just said the Trump inauguration. He's threatened a lot of punitive issues, more protectionist American policy, including tariffs, as well as perhaps more debt issues. The deficit has been a problem in the United States. How do you see that impacting China in particular, which is trying to get some traction in its own economy?
Well, I think if you step back once again and you look at some of the macro challenges in China, we're talking about the real estate sector, we're talking about local government debt, and we're talking about consumer demand. We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
You think that's what's going to happen in March? Because we've had some false starts, some false dawns, if you will, on the policy front. What would you like to see?
I think we would like to see continuous and sustainable steps towards addressing some of the more macro and fiscal challenges that China faces.
Will 2025 be tougher than 2024, though?
Look, every year, whenever we start a year, there's always this question, will one year be tougher than the other? One of the things that I've learned is don't always follow consensus. That was one of the things we learned when we went to Davos every year. Just think about scenarios, work through scenarios. You will always have additional information. One of the great things about GCC is figure out what is out there. What are the big knowns and what could be potentially the big unknowns, and how are you going to factor that in? Again, one of the key things that we are here to deliver is sustainable performance, sustainable impact for our clients. And we do that by making sure that their portfolios, their investment portfolios, are all-weather portfolios. And we work through this with our clients in making sure that they're diversified globally as much as by sector and theme.
Iqbal Khan, UBS Asia Pacific President and co-head of UBS Global Wealth Management, speaking exclusively to our very own Stephen Angle. And ahead on the show, Hong Kong's Financial Services Secretary Christopher Hui will be joining us from the Asian Financial Forum with his exclusive insights on the economic outlook and the city's status as a global wealth hub. This is Bloomberg. Welcome back. You're watching Inside, and Chinese markets just heading to lunch break. It's been swinging between gains and losses, plenty to mull over, by the way. Pessimism returning to China's stock market in a bear territory, down 20% since the high in October. By the way, the CSI 300 down 5% in the first 7 trading sessions of the year. Today, traders mulling over what PBOC Governor Pan has been talking about, that yuan support with verbal warning, capital tweaks as well. He did talk about how it has the toolkit to support the economy as well as the market. CSI 300 index currently down by 0.5%. Shanghai Com also in negative territory. The yuan is front and center, of course. That weakness is being supported by the PBOC 733.16. We saw that fix being really strong, 1,500 and change, stronger than what was anticipated by the market. The Hang Seng also under pressure, currently down by 1.3%. HS Tech down by 1.2%. Now back now to the Asian Financial Forum in Hong Kong, where the China Show's David Inglis is standing by with our next guest. Dave.
Yep, we are here, and as you can see, Rebecca's right beside me. Still, it's been a busy morning so far of conversations, and you know what? We actually saved you the best one for your hour, Has. Joining us exclusively here on set, Christopher Hui, Hong Kong Secretary for Financial Services, and the Treasury, joining us live here to talk us through many of the key themes today. Good morning, and thank you for coming here and joining us today. Yeah. The big surprise, we were trying to figure out who the VIP speaker was up until they went on stage. Han Gongsheng surprising most people. I'm guessing you were in the know. Yeah. Anything from what the governor had to say that stood out to you the most?
Yeah. I think the message is very clear that the central government is very supportive of Hong Kong as in the national financial center, and is going to work more closely with us in terms of having more measures in such a way that on the one hand we can continue to grow our connectivity with the mainland. That's number one. And number two is to grow the offshore renminbi market further. And thirdly is to grow our asset and wealth management market further. So I think these are very clear messages that we are appreciative. At the same time, we'll continue to work on.
Yeah, you know, funny story since you mentioned it. I just bumped into someone from the buy side just walking around here. I'm not going to name names, but really one of the big things that people want to talk about, to your point, is really connectivity, right? Some of the new products that, and I hope we can get to that later on. But let me just ask you very quickly, the big story in markets this morning too, is that the Fed, US Fed, doesn't seem like they'll be able to lower interest rates. We know, of course, we simply take that here in Hong Kong. A lot of people were hoping that rates would be lower this year for the property market and the economy. If indeed rates stay high, what steps is the government prepared to take to shelter the economy from higher rates?
Mm-hmm. As you can see, there's been a lot of market expectation in terms of how the interest rate may move going forward. But of course, I think it's a balance of different factors. You know, on the one hand, there's been talk about the tariffs. There's been talk about the potential control over immigration. So it may affect the rate of inflation in the US, which will also eventually affect the rate of which the interest rates may move. That's number one. And number two, I would say that in terms of our economy, the government has been doing various types of measures in terms of trying to grow and also sustain the competitiveness of our service sector. If you look at, like, for example, our financial service sector, taking advantage of the interest rate differential between renminbi and US dollar. In fact, we are seeing a lot of interest at the government level or the corporate level to issue renminbi bonds in Hong Kong because they want to leverage this gap in terms of, on one hand, issue more bonds for their own development, yet at the same time to promote their companies here through engagement with the global investors. So on the one hand, as you can see, that there are challenges, and also at the same time there are opportunities that different people in the market are capitalizing on.
And just thinking about the budget, I know we can't go into details, but you know, we've already had Paul Chan talking about the need to manage the fiscal deficit. When we think about the potential to raise taxes, are there any taxes the government is currently considering raising? I'm thinking, for example, raising a salary tax for those top earners, about 12,000 only employees who are in that category.
Yeah, and as you will appreciate, because right now we are in the process of consulting the community on our coming budget, which will be due for release in end February. So we are hearing a lot from different people. But that said, after all, the government cannot print money. What we can do is actually try to make sure that on the one hand, we can continue to have a constant source of income, yet at the same time, we can continue to keep our expenses in control. And these are exactly the two ways that we've been doing over the past few years. Like, for example, starting from this year, we already introduced a tier system to our rates collection in such a way that for rental of higher value, we actually subject them to a higher rates. But that said, when we do any rates adjustment, we are very cognizant of the fact that we have to be very aware of the potential impact on the economy and the community. And that's why, for example, when I talk about the rates increase that we just introduced, basically we only focus on the incremental increase to the rental above certain threshold that are subject to that higher rate, but not the whole sum. So whatever that we are going to propose to the budget, definitely we'll have the economy in mind, we have the community in mind, and also to ensure that the Hong Kong's role as a financial center and also as a place where we have a very simple taxation regime and also a very expected regulatory and business environment will continue to be there.
Just picking up on your last point about real estate, would you consider or would you rule out a property vacancy tax, for example?
I think right now, as you can see, when we do any major changes to the tax regime, we need to be very careful in terms of the impact on the economy and society. And that's why we are consulting the market and all at the same time to make sure that the community is aware of what we are doing and at the same time aware of why we are proposing anything. So I'm not going to divulge anything right now because after all, it's really a consultation process. But that thing, anything major, I think will require really deep societal discussion.
Is the sense that, I know you can't get into detail right now, and I appreciate, of course, the budget still coming out in a couple of weeks, but I guess simply to manage expectations of the market and stakeholders, to your point, that you don't want to shock anyone with a surprise move. I know you're in consultations, for example. Is there a sense, though, that the government might need to raise one specific tax or the other, or a specific tax rate this year? Is it something that we should be considering at least? I think just now I mentioned two ways that we are going to deal with our finances. On the one hand, of course, is to raise income in a reasonable manner. Okay. And that is something that we have been doing over the past few years. Like, for example, as I said, we introduced a tier system to our rates collection regime. And also started from the 1st of January this year, we start recollecting a hotel accommodation tax at 3%. Yep. So all these are already done. And when you compare the two avenues that we are pursuing, one is about the controlling expenses, and the other is about increasing income. Definitely the former is more important because it's something that within our control, and at the same time it's something that will be likely have less impact on the community. That's why alongside the income increase or any income changes that we introduced last time, we alongside actually having a fiscal consolidation plan in place to make sure that the governments are actually controlling the expenses, in particular on the operation side. So all in all, I would say the expense control will take precedence, yet at the same time we will look at various means to ensure that we'll have a sustainable fiscal management.
You mentioned some of the volatility or the reasons for volatility and Hong Kong's stability in that context. You picked up on that tariff word. I want to ask, how is Hong Kong preparing for the risk of tariffs from the US, and what are the kinds of discussions that officials are having behind the scenes?
I would say a lot of things that are already known is not something really unknown to anybody, because after all, as we entered into this new era in terms of concerns about geopolitics and whatever, this is something already ongoing over the past few years. So I would say that actually the market is quite adaptive and also resilient in terms of responding to these potential risks and also challenges. And back to Hong Kong, I would say, if you look at our capital market, stock market, and also our economy, I would say we are faring rather well in terms of responding to these challenges. Because number one is in this world of uncertainty, I would say, people look for anchor of stability. That's exactly what Hong Kong has to offer. If you look at going forward in terms of asset management businesses, one thing that we are looking in is in terms of how we will further amend our taxation laws in order to facilitate more tax concession for fund management and family offices in private credit, in carbon credit, and also virtual assets. So how we see this is we want to actually grow our traditional business, yet at the same time to ensure we are able to embrace the new economy economies in terms of the green, carbon credit, and also virtual assets. This is something that we have been doing in parallel over the past few years.
So we're here at the AFF, the 18th year. It's really a very international forum that, as you say, emphasizes Hong Kong as anchor of stability. One thing that some investors have mentioned, both privately and publicly, is a little bit of this frustration or the desire to move away from a national security narrative in Hong Kong. I wonder if you think the moment is right for Hong Kong to be emphasizing more of its differences from mainland China.
I would say it's always, in terms of a DNA, try to embrace our country, yet at the same time open to the rest of the world. It has been done before and will continue to be so. Like, for example, as you can see from today's turnout, we have more than 50 countries represented, and also we have more than 120 speakers, and also we have more than 3,600 attendees, which is, I would say, more than before. That's number one. And number two, if you ask me in terms of what differences you can see from this year's AFF from last years, I think you definitely see more representation from ASEAN, more representation from the Middle East, and also from the mainland. I think it is a very good sign that increasingly in this so-called multipolar world, people want to have more anchors and also at the same time more connectors. And that's exactly what Hong Kong should be and will continue to be.
And you mentioned other places in the world like the Middle East, ASEAN and Southeast Asia. Do you think, I think to follow on Rebecca's point, that message that, this one country, two systems, there, while things are the same, there are also unique propositions that Hong Kong can. Do you think that's resonated enough with investors that have really, when you look at from a reputation perspective, have had some questions around Hong Kong recently?
Definitely. If you look at the turnout today, definitely you can see that a lot of investors and also potentially issuers, be it equities or bonds, they come into Hong Kong, try to leverage the Hong Kong capital markets. That's number one. And number two, if you look at how the whole Hong Kong society has been working, basically one country, two systems is very much prevailing. And like, for example, I always say that you can still take the government to court and still win. It is really a jurisdiction where the rule of law prevails, at the same time open to business, locally, regionally, and globally.
Christopher, as you were mentioning earlier on, some of the things, of course, that people are looking forward to, which I guess we'll talk about next time, some of the specific tools and measures and products that Hong Kong is looking to put in place this year, of course, to attract more of the buy-side conversation. Christopher Hui, thank you so much.
Thank you.
For the time there. Of course, here on set with us at the Hong Kong Asian Financial Forum. Has, back to you in studios.
Great conversation there, Dave and Rebecca. Bloomberg's The China Show anchors David Inglis and Rebecca Chung Wilkins with Hong Kong Secretary for Financial Services and the Treasury, Christopher Hui. And there's more ahead from the Asian Financial Forum when we speak exclusively with Bank of Welcome back. We're inching ever closer to 11:45. Let's do a check-in on Indian markets joining the Asian trading day under pressure today. The Sensex currently down by about 1%. Nifty index also in negative territory. Of course, it's also about the rupee story, that a very weak currency versus the USD, making it really difficult for Indian assets to look attractive. In fact, some are suggesting that perhaps the Indian rupee could be testing new lows. Also to do with oil prices, remember that India is one country that is vulnerable to fluctuations in the oil prices. Oil prices have surged to a 4-month high as a fresh wave of U.S. sanctions against Russia's energy industry threaten to crimp supplies, where Brent crude currently trending higher, up by 1.6%. $81 is what we're looking at. The sanctions target Russian oil exporters, insurance companies and tankers, and may force refiners in India and China to seek alternative supplies. Let's bring in Bloomberg senior energy reporter Stephen Stepchinsky. Stephen, talk to us about these sanctions.
Yeah, so this is actually one of the biggest sweeping packages that the U.S. has implemented against Russia since the war in Ukraine began in 2022. These sanctions are important because they target 30% of essentially the oil that is shipped out of Russia. Citigroup says that's about as much as 800,000 barrels a day. To put that into context, that's a little bit less than 1% of global supply. But as you said, that's weighted more towards India and China. They've been more willing to take Russian crude, as well as sanctioned vessels that were under the dark fleet. Now, the U.S. actually had been allowing the flow of Russian oil to continue. There was the price cap mechanism, and they had sanctioned some vessels, but not many. This is a much larger 180 vessels that were targeted, as well as producers and shippers and insurance companies. So that threatens to tighten the market. You're seeing the price reaction right now with rates going higher. That's sort of opposite sort of the trend where prices were going lower. There was this expectation that 2025 would be a glut year, that there would be an oversupply, as well as weak Chinese demand, strong output from the United States. But now that discussion is shifting to show that maybe the market will be tighter with this recent action by the Biden administration. And while the Trump administration could potentially kind of reverse it or take away these sanctions, will it be the correct political move for him to do that? That's the big question at the moment.
So impact on supplies, tighter market, a possibility. The question is how much of that has already been priced into the markets and the prices we're seeing right now?
You know, I think right now we're essentially fully priced in at this $80 range. I don't think anyone's expecting to see price spikes that we saw back in 2022 when you saw rates jump above the $100 a barrel level for Brent. Now, that all being said, there's another factor, which is Iran. The Trump administration is expected to be tougher on Iran and whether or not they're going to put sanctions on them, another big crude exporter and producer. If there's a tighter restrictions on Iran and tighter restrictions on the sanctions that already exist on Iran, then that could further take barrels off the market, tightening things and pushing it up. Now, is that priced in? Is that not priced in? That's a question. There's some discussion that over the last few weeks with prices trending higher and people kind of piling the bullish bets before Trump takes over office later this month, that was an indication that people were expecting price action on Iran. Now, the recent package on Russia was not exactly expected. I think that there was an expectation that maybe the Biden administration would do one last thing as they were leaving, but I think that just from the price action that you see over the last few days with it jumping above $80 for Brent, clearly the market wasn't expecting such a wide-ranging sanctions package.
How much clarity on demand? We know that China's sluggish economy is not showing any signs of a turnaround, and India, a huge consumer of oil, and its economy has slowed down in a significant way.
Yeah, I think China is a big question. There are a few things happening in China, whether or not the government will push forward stimulus or different packages that could help boost the demand in the country. Another thing that we've been watching very closely, especially my team, has been the increase in electric vehicles. Now, yes, gasoline vehicle sales are still very strong, but EV sales, new vehicle sales, have been surging. And that does take some of the bite off of the Chinese picture there. And it's going to be, you know, depending on how many cars are sold, that will be a long-term effect for Chinese demand going forward. And its gasoline demand, while it's still somewhat incremental and it's not going to change everything significantly, it does indicate that there is a shift within China, especially as the government is trying to peak carbon emissions this decade.
So lots of things to consider still. Stephen, thank you so much for that. Bloomberg senior energy reporter Stephen Stepchinsky. And the price of oil will be a factor in December CPI data due out of India in the coming hours. Economists are expecting the inflation rate to slow down further from November. Bloomberg senior India economist Abhishek Gupta joins us in Mumbai. Abhishek, what are your own expectations?
Hi. So we're expecting December inflation to inch down marginally to 5.4% from 5.5% in December. Inflation in October had come out above RBI's target range of 2 to 6% at 6.2%. It already clawed back within the target range to 5.5% in November. So this should be another positive data signaling RBI will have room to cut interest rates at its February review.
To the extent of how much? 25, 50? What might the RBI do, and what might it do for the rest of the year?
Sure. So I think there'll be a lot of other data points as well, which the RBI will consider. Recently, the Household Consumer Expenditure Survey showed that actual inflation in India is about 60 basis points lower than what is being reported. This is according to our calculations. of that new data. What this new survey shows is Indians are spending a lower share of their overall income on food and more on discretionary items. And the current round of high inflation was being driven by higher food prices. So that should also play into RBI's calculation of what it might do at its February 6th review. So we are calling in for an out-of-consensus call for a 50 basis points rate cut. The consensus expects a 25 basis points rate cut at the February review. All of this is happening within the backdrop of growth slowing very severely. RBI had already revised down its growth projections in the December review to 6.6% from 7.2% earlier. The government's advance estimate has come up with an even lower estimate for the full year at 6.4%. Our projection is 6.3%. So overall, this does put that much more pressure on the RBI to start easing. Also, liquidity in the banking system has dried up and it's running in a deficit zone. So we expect RBI to sort of take account of all of these issues. And the good sort of development is that the hawkish structure of the Monetary Policy Committee would have changed a lot as well when the RBI meets in February. The RBI governor, the new governor, Sanjay Malhotra, has already said that he will start to look at prioritizing growth, and the RBI focus is likely to shift on growth in the coming policy. So we do expect the RBI to sort of deliver more than the usual 25 basis points of rate cut, because the economy really needs policy easing going forward.
You can only imagine that the RBI is also tracking oil prices right now. After all, fuel accounts for a big chunk of costs in India. And of course, when it comes to that as well, the rupee trending lower. Some expecting the rupee to test new record lows. I mean, how are you assessing the two factors?
So in terms of oil prices, yes, oil prices have risen up recently, but one needs to take account of how do these oil prices affect domestic prices. So domestic gasoline and diesel prices aren't really affected that much, because over the earlier period when oil prices were running low, oil companies, they did not cut domestic gasoline and petroleum prices. So going forward, I think if oil prices remain at the current level of about $80 per barrel, they will have some room for some time to be able to sort of absorb those. So RBI should not be worried too much about oil prices at the current level.
Bloomberg senior India economist Abhishek Gupta in Mumbai, we thank you so much for being with us today. Now, earlier from the Asian Financial Forum, we also heard exclusively from Pakistan's finance minister, who says his country is working very closely with the Chinese International Capital Corporation to issue an inaugural panda bond within the next 6 to 9 months.
I'm very keen, and the country is very keen to tap the panda bond. And the Chinese capital markets is the second largest, second deepest capital market in the world. We have been remiss as a country not to tap it previously. So we are working very closely. CICC has been appointed as our advisor on this. And what we are trying to do is to follow the Egyptian model, to get some level of credit enhancement. As you know, in Egypt's case, it was AIB and African Development Bank which provided the credit enhancement, and therefore they were able to launch. And we are trying to follow a similar track following Egypt's footsteps.
This quarter for the panda bonds?
Sorry?
Could it be this quarter for your panda bonds?
This quarter might be ambitious, but certainly during the next sort of 6 to 9 months, we hope to print an inaugural bond.
And as a final question, do you have an amount in mind with CICC? Have you discussed that?
For us, quite frankly, the amount does not matter that much, because our external situation is quite comfortable. But from my perspective, anything in the $200 to $250 million equivalent RMB range would be a good place to go for the inaugural issue. And then, of course, we can keep it on tap.
And that was Pakistan's Finance Minister Muhammad Aurangzeb. Keep it here with us. This is Bloomberg.